Okay, good morning, everyone. Yeah, my name is Jerry Sogoli. I work for a company called ZEP-RE Reinsurance. We are a regional company. We were created by member states of COMESA. We operate in about 60 countries within and outside Africa. We are headquartered in Nairobi, and we have 6 regional offices in countries of the region, including Addis Ababa. Our main objective, the mandate for which we were created, amongst other things, is to create reinsurance capacity by providing reinsurance for companies of the region, contribute to economic development. Mainly, we reinvest the premiums we underwrite from the region into the countries of the region. And lastly, we have the mandate of developing the insurance sector either through training, such forums. So I'm really honored to have been invited to speak at this forum. And my presentation will be looking at insurance regulations. Basically, I'm trying to share with you the practice that has been going on in the region, to see what countries of the region are doing to make their insurance regulation more effective and supportive of the industry. You may wonder why insurance regulation and what does it have to do with the growth of the insurance sector. We are used to, for a long time, this region was more used to the regulator being the licensor and just doing the investigations, but this is changing around the region. The regulator is being given more roles, with the development of the insurance sector being one of them. I think just for perspective, insurance has always been the poor relation in the financial sector, especially when everybody focuses on banking. So people tend to forget about the insurance, but you need to understand it's the second largest financial sector after banking. And it's very important in economic development. It's a source of funds for investment. The premiums people underwrite are put back into the economy. It's an employer. It's also the custodian of the risk transfer mechanism. People reinsure and they sit back, and in case there's a loss, the insurance companies are called in to pay. So it is very important that we sit back and ask ourselves, how can we make insurance better? From an African perspective, we are not as developed as the rest of the world. Currently, we contribute only about 1% of the global insurance premiums. Our penetration is on average less than 1%. I mean, there are outliers like South Africa where you get 16%, but most countries it's less than 1%. But the positive thing is that this region has the fastest growing insurance sectors. Okay, on average, the world growth rates have been about 2.5%. Africa is ranging between 7 and 10%. So we think this is the appropriate time to come up with a regulatory framework that supports this insurance. So you'll just allow me to go back into my presentation. Yes. I think the key deliverables I just want after my presentation is at least to have the delegates here understand the various approaches to reinsurance regulation, appreciate why most countries are now going to the independent system and how much positive it is for growth. And then, of course, during the discussions, I hope we'll be undertaking a surgery of what I've proposed with the independent regulatory model to determine whether Ethiopia is ripe for that model. So, what do we understand by insurance regulation? Basically, it refers to how the government oversees the insurance market to ensure fairness and professionalism. Why regulation? Although insurance contracts are private by nature, the impact of the industry means the government has always to come step in because we have public interest. Okay, companies going to pay the claims, service, whatever are the amounts that insurance companies have been given to invest, like in life products. Are they being applied to the right purpose. So that's why governments will always come in. And that's when the regulatory framework comes into play. This mainly comprises the statutory law. You'll have administrative regulations, and you'll have court decisions. That's what usually will comprise the insurance regulation. So if we go and look at the various types of regulations we've had, we have what we call the self-regulation. This used to happen in the past. I don't see any examples which are happening at the moment. In the past, you'll find governments will tell insurance companies, you regulate yourself, ensure you work fairly, but it's no longer whatever. And then you'll get a second version, which is the co-regulation, where the government partially regulates and asks the insurance companies to agree on standards and practices, and then they jointly regulate the sector. But the most common types are types 3 and 4, that's direct government regulation, where the government sets laws and resolutions, and through a department or an entity that the government controls, they oversee the conduct of the industry. This would be what would be happening in Ethiopia currently. And then we have the regulatory agency. This is where a public authority or government agency is created and given semi-autonomous powers to oversee the conduct of the insurance industry. The last part, this is mainly the independent regulatory agency. There are very few in the region. It's a form of agency that is mainly embraced back in the United States, where a regulatory agency is created, which is independent from the branches of the government. All the executive government does is appoint whoever runs that agency, but how it runs, the government has no control. So this last part doesn't really apply in this region. So I'll be looking at the direct regulation and the regulatory agencies for purposes of this presentation. If you'd allow me, let me now go to differentiation of the government-controlled oversight and then the regulatory agency. So, with the direct government regulations, what advantages do we have when we are looking at government control? One, you have easy access to policymakers. I mean, if the Minister of Finance is the one who is in charge of regulation, you always have access to him because he has to make policies. And we mean, by policymakers, we mean the people who drive decisions that will impact on the industry. Secondly, there is the inherent enforcement powers. You have the executive oversight, and the executive has those inherent enforcement powers. They have the investigators, they have the police, they have the prisons. So that is usually another pro to that. And then you'll always get policies that tend to favor the consumer. Consumer protection is usually a key advantage. Why? Because the government by nature is political, and they'll tend to drive towards policies that favor consumers because those are their voters. And then lastly, it's easy to get budget allocations since you have the Minister of Finance who drafts out the budget, so you are set when it comes to budgets. But on the disadvantage side is we have a government that is large and you have bureaucracy attaching there. So you tend to find that implementation of policies are usually a bit slow. The government has so many programs going. It's macroeconomic in nature. So sometimes you find the insurance industry issues are left behind. And then also policy making becomes unpredictable. You have a politician making policy, and this tends to change from one politician to another. So for an insurance company to plan into the future, that becomes a bit difficult. And then decision making, of course, will lack independence because they are driven with their own agendas, political agendas. And half the time for government regulatory agencies, you'll find most of their policies are reactive in nature. You're having issues, that's when they'll come with a policy to address that. Rarely are they forward-looking. And then you also have less visibility for the regulator. Half the time, the minister will drive conversation and the regulator will not be seen. When you go to the regulatory agency, what are you looking at? Some of the positives. You have a small agency that has been created specifically to address the needs of the sector. So you have a dedicated agency, and that means they are able to address the needs of the sector without being interrupted by other issues. Also, policies are proactive because most of these agencies are required to come up with work plans, with strategy plans for the industry. So they tend to be more forward-looking in nature. And then they are accountable not only to the government but to the stakeholders. because the stakeholders are the reason for existence. And then there's more visibility for the regulator. Why? He's the first point of call and the last point of call. So whatever goes wrong with regulation in the industry or oversight, there's always one point of reference, and that's the regulator, and is usually more visible. On the disadvantage of the regulatory agency, sometimes if you don't get a very well-structured agency, they can be victims of political stakeholder capture. I mean, if there are too many powers resting with the minister, despite having a regulatory agency overseeing your oversight, sometimes they don't work well. And then sometimes regulatory agencies may not have powers to enforce oversight effectively. Or sometimes the agency may be removed from key policy makers. They don't have access to the minister, they don't have access to parliament, so it becomes a little bit harder to push policy. And then lastly, if the budget allocation structure is not very appropriate, you'll find the regulatory agency may lack funds, thereby hindering its work. So you may ask, there'll be a slide I'll be showing you of what government in the regions are doing, but you may be asking yourself, why are governments moving from direct oversight to independent insurance regulators? One is just effects of political meddling. Over time, we have found that lack of independence in oversight has always resulted in financial crisis, because governments will always respond in it may be the best way, but sometimes it doesn't work for the industry, because they are more answerable to the people than the industry. So in many of the world's recent financial crises, politicians and policymakers tended to intervene in the work of regulators, but it didn't work out. And then secondly, governments have looked around to see similar jurisdictions, what is happening there. You look across your neighbor, you find they have a regulatory agency, and it's really contributing to the growth of the insurance industry. So they tend to benchmark and decide, I think that's the way we should be going. So, I think I've mentioned these reasons why governments are going the other. If you allow me just to go to the next slide. Yes. So, what would you be looking as one of the key characteristics of an independent agency? One of the key issues you need to look at is regulatory independence. Does the regulator have autonomy in setting rules and regulations? So does he have to call somewhere before he sets the rules? Supervisory. Is he able to supervise the sector without fear or favor? And then institutional independence. Does he have autonomy to hire staff? Does your regulator have security of tenure? And then budgetary independence. Does the regulator rely on his internal budget? Most of the regulatory agencies have come up with industry fees to fund them as a way of ensuring that you don't have to go to parliament every other time to ask for money, so that you can work on that. So, and if you look at qualities that will always make that regulatory independence agency effective, you need a regulator who is independent, you need accountability and transparency, you need to understand how they reach decisions, how they make policies for the industry, does he engage stakeholders before he makes these decisions, how is the appointment of the regulator done? How is the regulator removed? Does you just get a call from the cabinet office and you're out of a job? The organization and the operations of the regulator, are they independent? Is he able to hire staff? Is he able to get the right people he wants? Is his budget funded internally? So if you would allow me, since I'm told time is running out, I just want to take you to a structure, just to show you what the governance structure of an independent regulatory agency and a central bank oversight. You can see on the independence, you have your board, which normally is the main authority. And then there's the CEO and their specialized divisions. So you can see your regulator has access to his board directly. If you go to the central bank oversight model, you'll find there's a board, there's a governor, and you have the vice governor for regulation. So your insurance regulator has to go to the vice governor of regulation before he goes to the governor. You can understand the challenges in your regulator pushing the agenda of the insurance industry. On the one hand, if it was independent, he would have access to his board and his chairman and push his ideas. But on this other one, he's competing with the banking regulations. He's competing with central bank issues that deal with foreign exchange reserves, being the clearing house, their policy makings for the banking. And I told you, insurance is a poor relative of banking. So he's competing with so many issues that it makes it hard for the regulator to actively drive that agenda. That's why sometimes you find the insurance industry is left behind. So quickly, I'll just share with you countries of the region which have moved from the central bank oversight. Currently, Ethiopia, Rwanda, and Malawi are the few countries in this region which still use central bank oversight. But most of the countries, including Kenya, Uganda, Tanzania, Zambia, Zimbabwe, DR Congo recently, which didn't have a regulator 2 years ago, have brought in ACA. Burundi is also using ACA. So you can see a lot of people now are moving to the independent side, and there must be a reason why. And then I think I had a presentation about Kenya. I'll just go quickly. The history of Kenya. Kenya, before 1984, they didn't have a regulation. We had a lot of issues, especially with insurance company collapses. As a reactive method, the government formed the Office of the Commissioner of Insurance. He was supposed to provide oversight, but it was a department in the Ministry of Finance. And it didn't work out. On average, you used to get an insurance company collapse every 3 years. So in 2006, the country decided to create an independent regulatory agency. It's called IRA, Insurance Regulatory Authority. What happens since then, I think we've just, in the 17 years, only 2 company collapses. But one of the key areas that regulator has really helped is in the area of regulations and guidelines. They have come up with corporate guidelines, corporate governance guidelines. Life and general insurance have been separated. Establishment of a policyholders pensions fund, localization of life and marine business, guidelines to help bank assurance, takaful and insurance. Right now they are working on the digital method, on the digital distribution method, and they have even established an insurance fraud investigation unit. So in summary, I think they'll share this paper with the participants. You can go through it. A very good example is what has happened in Kenya from the time when they moved from government directed. You've seen a lot of positives attaching to the regulatory sector because the regulator has become more proactive and brought in a lot of policies that are meant to help the insurance sector grow. So with that, thank you very much for listening to me. I'll be seated here. I hope they'll share with you this presentation through your various emails. You could read through it. And if you have any questions, I'll be on standby to answer. Thank you very much.